Hello everyone, and welcome to another edition of ITPM Flash. My name is Jason McDonald, and I'm a Senior Trading Mentor at ITPM. Today, I'd like to talk about the regional banks in the US. I'm bullish on the KRE, ticker KRE, the Regional Bank ETF. As you can see here, we have a 12-month chart of the KRE, which is the S&P Regional Banking ETF. In November, after the election, you can see it made its recent highs. Since then, obviously, we had the sell-off at the early of the year, and now we've started to regain traction again, with the ETF being just above its 200-day moving average, but still below those November-December highs. So what's been happening with the fundamentals and the regulatory aspects of the US banks? At the end of May, beginning of June, the Senate finally approved the appointment of Michelle Bowman as the Federal Reserve's Vice Chair for Banking Supervision. She is interpreted as a light touch advocate with respect to banking regulations. Since she was confirmed in her role, the Trump administration's program of banking deregulation has started to go into full swing. The Fed was waiting for Bowman to take up her new job before releasing new supervisory ratings for US bank holding companies. She's already on record last year as having said that those regulations are overly strict. Under Bowman, we definitely expect more accommodative supervisory ratings for the banks. Also, Treasury Secretary Scott Bessent said back in May that the growth of private credit tells me that the regulated banking system has been too tightly constrained. So we could really see the pace of bank deregulation in the next few months becoming quite aggressive. If so, US commercial bank earnings and stock prices will continue to benefit. There's going to be a 60-day consultation on the deregulation plans, with Michelle Bowman saying that she welcomed feedback on the idea of excluding treasuries from what's known as the SLR, the Supplementary Leverage Ratio calculation. What is the SLR? It's a regulatory measure used by banks to ensure that they maintain a minimum level of capital against their total exposure, including both on and off-balance sheet items. It essentially acts as a backstop to risk-based capital requirements and is designed to prevent excessive leverage within the banking system. If this is loosened, it means that banks can expand their balance sheets. In other words, they can lend more, which increases their profitability. Looking ahead, the capital framework for US banks is expected to be further loosened up. The Fed will convene a conference on July 22nd with market players to discuss key rules, especially the design and the calibration of leverage ratios. Under Bessent and Bowman, financial deregulation is expected to have three elements. Number one, less stringent rules for determining bank capital buffers. So we could see the likely relaxation of bank supplementary leverage ratios, potentially by excluding holdings of US treasuries from the calculation. Bessent says this could happen in the next 3 to 4 months. The second element relates to the regulators. So the administration would like to see more coordinated and streamlined regulatory oversight. Previously, different US bank regulators have sometimes been working against each other. Now they are under orders from the administration to work together. These orders are working. For example, in April, the Fed and the FDIC, the Federal Deposit Insurance Corporation, and the Office of the Controller of the Currency together relaxed their guidelines for banks' crypto businesses. And the third element is faster and readier regulatory approvals of bank mergers and acquisitions. The April approval of Capital One's acquisition of Discover Financials set a new precedent, with more deals likely. This deregulation bodes well for bank earnings and for bank stocks, along with several other factors that also favour US bank shares, particularly the regionals. Here's a chart showing bank merger and acquisition activity under various administrations. What you can see is that A, the number of deals completed under Republicans is far greater than the number of deals completed under the Democrats. Also, the black line shows you the timeline of how long it takes for these acquisitions to be approved. And as you can see, the timeline is much shorter when you have a Republican administration in power. So in other words, what we should see under the Republican administration of Trump is more M&A deals and shorter time horizons for these deals to be approved. If history is any guide, the downturn in bank M&A will now reverse, Trump's first term saw 51 US bank M&A deals completed, compared with 32 deals under Biden and only 32 during the 8 years in which Barack Obama was in power. Deals were also concluded more quickly under Trump, typically in just over 6 months, compared with more than 9 months under Biden. The US macroeconomic backdrop is also a tailwind for the US banks and especially the regionals. US recession fears have definitely receded, partly as the tariff war de-escalated. The big beautiful bill tax cuts are likely to continue to steepen the US yield curve. A normalized yield curve improves what's known as the bank's net interest margins. In other words, a steeper, more normalized yield curve, which is what we've seen developing, increases bank profitability. Looking at the sector's 12-month forward price to earnings ratio, US bank stocks also trade at a discount to the overall market. As a consequence of all of these tailwinds on the macro side, US bank shares should continue to outperform the broad US market. Here's a chart going back to 2010 showing you the forward price earnings ratio of, with the blue line, the overall market, and the red line, the US banks. As you can see, the banks tend to trade at a discount in 12-month forward PE terms. However, in the last few years, that gap has actually widened. I'd expect the gap to close somewhat and to continue to close based on the regulatory relaxation that we're going to see, and also based on the US macroeconomic tailwind. Since March, there have also been signs that bank lending is picking up. Commercial banks are no longer tightening their lending standards, and according to the National Federation of Independent Business, the NFIB, small businesses are seeing a significant improvement in loan availability. There's a fair chance that this trend will continue. As a consequence, US bank shares, particularly the US regional bank shares, should continue to outperform the broad US market. On to the potential trade structure. This particular trade structure is based on a representative $100,000 portfolio. It's initially what we call a calendar spread that then is turned later on into a straight vertical spread. So the initial part of the trade is basically going long September $62 strike calls on the KRE and short August 65 strike KRE calls. We do this on a 2-to-1 ratio with the calendar. So with this particular example, the idea would be to buy 28 contracts of the September 62 strike calls and selling 14 of the August 65 strike calls. As you can see, there's quite a decent credit there if the KRE is at 65 or below by the August expiry. Assuming that we take that credit after the August expiry, we would then turn this trade into a September vertical where we're long 28 62 strike calls on the KRE and short 28 70 strike calls on the KRE, on a 1-for-1 basis, in other words. Now, as you can see from the calculations there, this would work out at a 4.5-to-1. In other words, for a 4,100 net spend, if the KRE is at 70 by the September expiry, the profit would be $18,228, which is a 4.5 reward to risk return based on the 4,100 net investment. Remember, we're running long-short portfolios using underlying and options with a small directional bias. So this is just one example of something that you would consider putting into your portfolio to play both the regulatory easing and the favorable US macroeconomic backdrop for US regional banks. Thanks for watching. See you next time.